slightly quieter week coming up, at least in terms of macroeconomic news, with a main feature of note on the domestic front being the latest inflation figures on Wednesday the 13th of February. Now for December, the Consumer Price Index, or CPI, showed an increase of 2.1% year on year, down from a peak in 2017 of 3.1%, and it's been down helped by falling oil prices. The Retail Price Index, or RPI, well, that showed an increase of 2.7% year on year, down from its peak of 4.1. Now those are the grey and red lines respectively on this chart. The good news is that the black line, wage growth, is now outstripping both, which may finally put some welcome extra cash in the kitty for consumers. Also remember that the Bank of England's official inflation target is 2%, so a drop in CPI and its preferred CPIH reading, which includes housing costs, will make it even less likely to dash and increased interest rates. Current consensus here amongst economists is for one rate hike in 2019 from 0.75 to 1%, although Brexit remains a bit of a variable there. Now there's going to be a bit more company news for us to mull over, however. Around half a dozen FTSE 100 firms are due to publish results or release a trading statement or host an analysts meeting, as are a good selection of FTSE 250, small cap and AIM quoted firms. Names seeking just a little bit of love in the week of Valentine's Day will include gold miner Acacia on Monday the 11th of February, TUI and AA on the 12th, Premier Inn owner Whitbread, Tullow Oil and retailer Dunelm on the 13th, drug developer AstraZeneca, Coca-Cola Hellenic Bottling Company, Micro Focus and house builder and land developer MJ Gleeson on the 14th itself, and finally online retailer ASOS, real estate investment trust Segro and Funding Circle on Friday the 15th of February. But for all of the interest that lot could spark, especially ASOS as it tries to bounce back from December's disappointing trading update, the stock that could really cause a fuss in the week ahead is Royal Bank of Scotland. RBS is due to release its fourth quarter and full year figures for 2018 on Friday the 15th of February. Now, even allowing for a welcome New Year rally, the shares have done pretty poorly over the last 12 months, hampered by concerns over what Brexit may or may not mean, and the UK's broader economic situation. Even some relatively consistent profits and the reinitiation of dividend payments, with a 2p per share distribution at the first half stage, did little to stop the rot. Now, it'll be of little consolation to boss Russ McEwen and his team, or shareholders for that matter, that the whole bank sector did badly in 18 in the UK and for that matter globally, at least share price wise. Mr McEwen and his colleagues will be looking to stop that rot, and that development would be particularly welcomed by all investors, and therefore that means the government as well, or in fact we taxpayers in other words, who still own a 62% stake after last June's sale of just under 8% of the shares. Remember, the government's average purchase price is 502 pence a share. Now, when it comes to the numbers, the first one that investors will latch onto will be the headline pre-tax profit figure. RBS has been in the black, believe it or not, for 6 of the last 7 quarters, as we can see here, and the trend is pretty good as well. But also note that it did make a loss in the fourth and final quarter of 2013, 14, 15, 16 and 17, as that's when it's tended to book further restructuring costs, reassess its loan book for any losses, and also counted up potential liabilities relating to Payment Protection Insurance, or PPI. On this occasion, analysts are looking for a full year pre-tax profit figure of 4.6 billion. That's up from 2.2 billion a year ago and actually implies a fourth quarter profit of 1.8 billion. Now, in terms of the drivers of that profit improvement, there are 2 particular things to watch. The first is the top line, whether RBS is still shrinking itself back to health or moving into growth mode. As we can see from this chart, RBS has grown its deposits year on year for 5 straight quarters. Maybe customers are regaining some faith in the bank 11 years after its government bailout, but risk-weighted assets in its loan book are still shrinking, as this graphic shows. Then that takes care of the top line. Then comes the costs. At the start of 2018, Mr McEwen targeted a £750 million cut in operating costs, so keep an eye on that. And an even bigger swing factor will be restructuring costs, litigation and PPI charges, and bad loan impairments. That lot has cost RBS £33 billion between them since 2013 and £3 billion in the first 9 months of 2018 alone. Now, if the bank can really start to reduce those costs, then profits could start to advance quite nicely. Though intriguingly, the analyst consensus is looking for broadly flat profits in 2019 at £4.7 billion. Attention will then move on to the dividend. Now, once it had finally satisfied European state aid regulators regarding the Williams & Glynn subsidiary, settled with the US Federal Housing Agency, and in principle reached a $4.9 billion settlement with the US Department of Justice, RBS declared that 2 pence per share first half dividend. The big three obstacles were finally out of the way. For the full year, analysts are looking for 7.1 pence, followed by 12.78 pence a share for 2019. This final graphic shows RBS dividend history going back to 2005, adjusting the historic payments for the current post-bailout share count. As we can see, the 2019 forecast still represents barely half of the past peak in millions of pounds. The 2019 estimate of 12.78p, by the way, if achieved, would put RBS, on the basis of a per share price around 240 pence, on a dividend yield of 5.3%. Now, only you can decide whether that forecast yield offers sufficient compensation for the risks involved, especially in light of recent comments from challenger banks such as Metro, Paragon, CYBG, Banco Santander and Banco Sabadell, the owner of TSB. They've all talked about competition leading to margin pressure, especially in the field of mortgages and customer deposits, more expensive funding of the Bank of England's term funding scheme has ended, and that uncertain economic environment in the UK. Let's see what RBS has got to say on those themes and more. Thank you for watching, and I look forward to seeing you next time.